tough. Anand, what about earnings season and a couple of misses over there? I mean, people weren't very happy, specifically with infrastructure and the earnings over there. For stocks like L&T and Punj Lloyd, what did you make of it?
So clearly there seems to have been a slowdown in the top line, at least for most of the construction companies, which given the current order book seems to be rather surprising. We've been trying to figure out what the reasons. I think the reasons broadly that we've sussed out seem to be that, either there has been some issues in terms of, especially when you're talking about, for example, the power sector, in terms of getting the right technology at the right time. Money right now doesn't seem to be much of an issue. Though in some of the states we are hearing that, because of the elections and all that, the expenditure got a bit postponed. But otherwise, as I see it, there is, other than implementation issues, for example, on road and so on, which is land procurement, there is nothing that much in terms of what the last cycle brought out, which was the lack of availability of finance. So finance is available. To some extent it was technology in power, and to some extent it was land acquisition in road. Both of them, I think, are solvable problems. The first one more easily, the second one a little less easily, but I think the government seems to be on the right mode in terms of trying to figure it out. And therefore, a sharp drop in construction is an area I would definitely look to add to, because that's probably one of the few places where, you can see a sustained longer-term order book growth even now.
Anand, where do you stand on this high beta versus defensive argument? A lot of people seem to be saying now that stay with defensives, shun the high betas. Is that a risky strategy, or would you go with it?
Well, then it's a question of definition. I mean, I think, the beta for most stocks changes very rapidly. Many companies which were low beta 6 months ago would have become high beta now. So effectively what you're saying is that you would move with a sector which is going to do well. I mean, you take a sector like pharma, 3 quarters back, nobody was willing to touch it. And it's been one of the best performing sectors. So, would you call it high beta? I'm not necessarily sure that the beta has changed. I mean, the concept of beta is what people had in mind when they were talking at pharma. But undoubtedly it has proved itself to be quite high beta. I think essentially what people are really looking at is to say, look, if the market were to react, you want to go to those companies where there is less likelihood of a sharp price reaction. And therefore, implicitly there is a differentiation being made on the beta on the upside versus beta on the downside. I think essentially what one would have to look for is liquidity, because in a market which is less likely to go up and more likely to go down, you want to be in liquid names because you can exit. I'm talking as if you're a fund manager of a mutual fund or a long only fund. Therefore, there is always that flight to larger names. The second thing that seems to determine this is obviously wherever the earnings growth possibilities are higher. And sometimes that coincides with high beta, but not always. So I would, like I said, if you say construction is high beta, I would tend to move towards that. If you're talking about banking, for example, I don't particularly consider that highly volatile sector, but it is a sector where, like Sudarshan mentioned, we have reasons to argue that on a fundamental basis, there is clearly market share gain that public sector banks have seen in this quarter, and we think that it's likely to continue at least for the foreseeable future. So, I would, and the valuation gap still is in favor of public sector. So I would actually go along with buying a Bank of Baroda, which is not particularly high beta or defensive. It is just a bank which is likely to grow faster than the rest of the PIB group.
What do you do with some of the more recent power listings, Anand?
There are recent listings which don't even have a PPA in place, and therefore no financial closure, no ability to go and sell anything. But the market has been very kind and has allowed them to raise capital. As I said, right now the market seems to be in a mood that, for a bunch of sectors, they are willing to put up money even though they know that there is no near-term ability to make money. Over a longer period of time, power, I think, will be a place which will continue to attract attention. I mean, broadly speaking, the numbers we are looking at is that in the next five years, even if you take a discount to plan, we will still be about 50% higher in terms of power output than what India has managed in the last 65 years. So, that will obviously be a sector which will continue to have a lot of fundraising as well as need to raise capital. And, the more sustained management, I would look at backing up those where there is greater execution capability, already some power plants on the ground, because that will at least provide some stability in terms of earnings. As the merchant power increases, I think initially merchant power prices are likely to go up. But I think towards, on a slightly longer term basis, that obviously has to stabilize, because, you are really supplying to peak power there, and that can't necessarily be going at very high prices all the time. So that's basically the call. If you can raise money now, good for you, because longer term it's a good business to be.
How would you approach these PSU stocks where the government, which are listed, but where the government holds 95, 97, 98%, where there is a possibility that they might sell a bit more? Would you get excited about them?
Well, if it's names like NMDC, etc., I think absolutely. Though, there may be a bit of a liquidity overhang. It depends on how they disinvest. But I think overall the businesses are such that I think in the environment we are operating, they will continue to do well. For the ones which, let's say an HMT or something of that sort, I'm not necessarily sure that there is any value in that company other than perhaps some land somewhere. Many of their facilities are actually rusted perhaps. And therefore, unless somebody is looking for some specific contract which comes along with it, I'm not sure that will necessarily excite a lot of people.
How would you approach real estate as a segment now, Anand?
A bit cautiously. I think they've had a nice run because money has become available, and therefore to some extent, at least in metro cities, demand and transactions seem to have picked up. But I think if you're looking at money again going out of the system for a little while at least, I think you'll see some correction there. We've not seen a serious price correction lasting for any length of time, except perhaps in a few pockets around the country. Which has obviously has boosted up the bottom line quite a bit. But I would still remain a little circumspect at the valuations we are trading at.
Suzlon Energy is still up 5%, but the volumes on that stock are astounding. I mean, it's easily the top traded counter on the Nifty today. Big volume action on Suzlon very early in trade. I mean, it's been just about, 5 minutes. Anand, what about FMCG? That actually came out as the dark horse in terms of earnings, ex-lever. What would you like over there?
So I think, we've seen the best quarter in the current results. For the most part, they've, like you said, done exceedingly well, except especially the smaller companies. The question is that, they usually do well at a time when the initial part of the commodity cycle starts to pick up, and they haven't actually, and, they've managed to keep the prices high. As you go along, especially, for example, the food companies in the FMCG space, you would have to expect that food inflation will continue to rise, which will mean that their input costs start to rise and their ability to pass on will become a little more suspect. So I would think that especially for food companies, margins will become a little more strained in the quarters going forward. The non-food ones, obviously, something like ITC has many triggers. We did re-estimate of what based on the current earnings, but it doesn't look like too much additional because most of the sectors are doing well, but hotels are not. So the earnings-wise, it is not likely to move up significantly, and valuations are more or less fully pricing in most of the upside for the near term. That just leaves levers. I think levers still struggling with its growth ability, and while it did show up a fairly nice little rally as far as lever goes, when they announced that they would look at market share gains, it quite quickly fizzled out because I don't think that they are quite ready yet in terms of being able to push very aggressively.